Welcome, everyone. So today's webinar continues on on what we did last month in September. Again, in many ways, we don't understand what a government is, how they operate, what's the financial structure, and how governments are held accountable. And it's why we're here. And it again will make good fodder, for the holiday season while you're sitting around the dining room table. We certainly hope you have fun, and some of this stuff may cause you to think about why it's so important to do what you do in serving the public, either as a preparer or as a auditor. My name's Eric Berman, and I'm a partner with Eide Bailey in our Boise, Idaho office, as Amy introduced. Now today, we're going to start off by doing a quick recap of our September webinar, just in case you forgot something. And of course, September was so far long ago, you probably will have forgotten a few things. Now, after the recap, I'm going to take a deeper dive into funds, which for some decision makers are more important than reporting on the entirety of the government. And throughout your career, you're going to find that some policymaker, manager, lawmaker is just going to focus on one fund. And you can be at a city council or a school board meeting, and you're going to get a question about it as that is their pet fund, and that's all they care about. So fund reporting is really important. Now, others want to focus on the whole, which makes governments a little more comparable to not-for-profits. Now, we're going to also take a look at how transactions differ between the types of funds and the entirety of the government. And then I'm going to wrap up today's session just by skimming the surface on what it means to be an auditor of a government. Let's just keep going and do a quick recap from September. The financial reporting entity of a state or local government is a pyramid. That's the way I've always thought of it throughout my entire career. The base is all the organizations that are accountable to the primary government as determined by the primary government. And accountability is based on criteria that is embedded in GAAP, and that criteria is financial and non-financial. There are these things called component units, and they can issue their own separate reports and have separate audits. And the next level is based on financial accountability. And the top level is the primary government, which has oversight by citizens, which are, as we know these days, the ultimate accountability is at the ballot box. And the levels below the primary government, again, these are known as component units, as they're pieces of the primary government, but legally separate. Given the pyramid, this derives the structure of our annual financial report, or AFR. Now, component units, we can do just an entire 2 hours on what is a component unit and how do they report and the different flavors of component units. So we don't have time for that today. I'm just going to leave that, for your government 201 course. This is just government 101. And so let's keep at that level today. Now, AFRs are a vital piece of accountability if they are read. Too many potential users of an AFR only read the auditor's report. Maybe they count the paragraphs and figure that things are okay, but those folks are having issues lately. As many of us know, the auditor's reports have changed. Now, all these groups should be reading the AFR. Many AFRs are prepared in accordance with GAAP, but others are not. They're prepared in accordance with a special purpose framework, otherwise known as a SPIF or UCBOA. It used to be known as UCBOA. And these frameworks are either required by law or regulation, or they have some statute that allows flexibility in implementing GAAP. And these special purpose frameworks may be in place for regulated governments or for small governments where the cost of implementing GAAP really exceeds the benefit, especially for those governments that do not have outstanding debt. And they do exist out there, and it is common that there is special exemptions provided, say, by a state entity for implementing GAAP. The third concept statement from the GASB, which establishes the framework of financial reporting, this third statement puts into place the interrelationships of reporting and how reporting is used to assess not only accountability, but due to risk assessment and other factors, how does a government allocate its resources? What sort of investments do they invest in? And procedures and other decisions are made based on some form of reporting that is in this matrix. Many of us focus on the lower left, the basic financial statements, and it might be small on your screen, but just realize that it's there. The basic financial statements includes the notes to the basic financial statements, but GAAP requires supplementary information. So we're over in the second green box, and some of that supplementary information is required while others is just not. And in certain types of reports, other supplementary information is not required for AFRs, but it's also down in that second green box. So what else is in the accountability realm? The other information includes things like open checkbooks and transparency websites that governments have, which are really phenomenal tools that have come into place over the last decade or so. Reporting to federal websites required by federal grants could be in there, and investor-focused websites. Even the website of your government is within this matrix. Now, this other types of information, which is moving over to the right, to some, it's really more important than financial reporting, but the problem is it's not audited. So a government's basic financial statements include a statement of net position and a statement of activities. The statement of net position is like a not-for-profit statement of the same name. The statement of activities has different geography and elements, but also just like a statement for a not-for-profit. Now, both comprise what we call the government-wide statements, and both are prepared using the economic resources measurement focus and accrual basis of accounting. Now, you may know this as full accrual, which is exactly what it is. It's exactly like a business or a not-for-profit, but remember, we don't have any shareholders, so our equity section is a little bit different. Now, due to the accountability focus of a government, funds are presented. And government funds, or governmental funds, excuse me, they're the core operations of a general purpose government. The reporting is currently based on the current financial resources measurement focus and modified accrual basis of accounting. Notice I said the word currently because it may be changing in the future. A balance sheet is prepared like many organizations, and the income statement is the statement of revenues, expenditures, which is different than expenses. We'll talk about that a little bit later today, and the changes in fund balance. Again, the term expenditures is used due to the different basis of accounting, and this basis of accounting is best described as almost cash in and cash out, which makes things a little bit easy to understand for preparers, but for decision makers, it may not be so easy. Now, due to the different basis, a reconciliation occurs between the governmental funds and the government-wide statements showing all those differences in the basis of accounting. Now, remember, we have options for reporting. The ACFR, or Annual Comprehensive Financial Report, or an AFR. Both the ACFR and the AFR have an independent auditor's report followed by a management's discussion and analysis, or MD&A, of the balances and the results of the operations for the year for the government. Now, the core question in the MD&A is the magic word why. And, you know, my 3.5-year-old grandson, he's in that age. He always asks why. And so why did the balance change this year? Why are things different than last year? The basic financial statements are then presented, and I'm going to break this down in a little bit. These are followed by the notes to the basic financial statements and required supplementary information schedules, or RSI. These are required by GAAP. Now, special purpose reports are meant to provide mainly accountability information to some decision makers. And the most common special purpose reporting is for bondholders. But other reporting may be required by a state or by some other law or regulation. Other reporting could be contained within a bond offering statement to prospective investors in the government. And we also find reporting on construction projects to decision makers and grantor entities, or compliance reporting to state regulatory bodies such as those involving education, public safety, utilities, and so on. There are other general purpose external financial reports that are presented by governments, such as smaller popular reports and citizen-centric reports, which many governments issue. And many governments issue these as a communications document to those who do not have enough time or understanding of the process, of the process of preparing the annual financial report. It's just a summary. So to recap on the content of ACFRs and AFRs, the basic financial statements are contained in AFRs. Additional information may be presented in an introductory letter, supplementary information, and combining information, as well as statistical information on the government. Now, those are part of, again, that annual comprehensive financial report, or ACFRs. ACFRs are not required by GAAP, but there is GAAP for such reports if they are presented. So you may want to dog ear this if you have it printed out, or just keep it handy, and refer back to it. If you're, a brand new preparer and you just don't understand what is part of each type of report. So governments have one fund that is the major operating fund. That's called the general fund. And the focus of an audit is going to be there. Other funds are audited based on quantitative and qualitative measures. Each fund stands alone due to the phrase known as self-balancing in the definition of a fund. And we'll talk about the definition in a little bit. Yet there are often transactions in between funds. The major funds of a government have separate audits. The smaller funds are then audited together as one opinion unit. The other funds are based on math or on judgment. Now, if the fund is over 10% of any of the elements, and the elements being assets, liabilities, and so on of the entirety of the funds in that fund type, and the fund is over 5% of the element of all government or and enterprise funds combined, then the fund is a major fund. And it's a pretty complex calculation that is done very early in the process of an annual audit. But a government can say, hey, even though this fund is non-major, we want this to be audited because there's somebody out there who really wants it to be audited, and we want it to have its own opinion unit. Obviously, that adds audit procedures, complexity, reporting, and frankly, cost. So a government should let the auditor know about this desire well in advance. And all the other funds are grouped together within its own opinion unit. Now, once the major and non-major in the aggregate are known, for the audit, materiality, risk assessment, and procedures are planned, in advance. That's all part of your interim work and planning work that's done well in advance of, hopefully, of year end. Now, most auditors include this information as part of communicating with the government because planning is so important. Documenting that communication is key. And nothing is worse than getting close to the end of an audit and then finding out that something else should have been audited, but it was not included. That means we got to, stop the presses and get going on that other element that just wasn't audited in advance. For the auditors in the webinar and for the preparers, For your information, this is how opinion units in your auditor's report are determined in comparison to reporting units. Now, keep this one handy along with the footnotes that are on this following slide here, because again, and I'm going to go back 1 second here, every single time we plan and perform the audit, we refer to this exhibit that is within the state and local audit guide. And it is so important. And it's so important to realize that opinion units for the auditor may be different than what we report in the various elements of our financial report, because a bunch of these boxes are aggregated. And you can see that in the 4th or 5th row down on the screen here, where it says remaining fund information, aggregate all as a single unit. And we also include the discretely presenting component units. Remember, those are going to be in the governmental 201 class. We're just at government 101 right now. But just realize that all these other funds are one opinion unit, even though they may be separate pages and separate sections of your annual financial report. Now, let's delve a little bit deeper into your financial statements. Here again is the structure of your AFR. We start out with the auditor's report, then the MD&A, then the basic financial statements. They have to go in that order. The basic financial statements, again, are also known as the government-wide financial statements, as they encompass the entire governmental and business type activity of your government. The governmental fund statements will follow, which we'll spend some time in over the course of the webinar. After that, additional fund statements are presented for the proprietary funds. As the word proprietary means, these operations are really close to business-like. They're presented using the full accrual basis of accounting: a statement of net position, a statement of revenues, expenses, and changes in fund net position, and a statement of cash flows are prepared for these funds just like a business or a not-for-profit. Now, the statement of cash flows is prepared using the direct method, but otherwise pretty much just like a business or a not-for-profit. Finally, a government may have fiduciary activities, including pensions and other employee benefit trust funds, investment trust funds, private purpose trust funds, and custodial funds. In short, this is where a government is a trustee over somebody else's fund or some other government's funds. Now, these funds are not the government's own monies. The funds are also presented in full accrual with slightly different titles, but guess what? No statement of cash flows on fiduciary funds. And we could talk about fiduciary funds and fiduciary activities also for many hours, but beyond a little bit further in the webinar when we introduce them again, beyond the scope of today. Remember, special purpose governments have only one or a few activities. If they're like businesses, they present like proprietary funds. If they are a fiduciary activity, they present like a fiduciary fund. And again, in September, I introduced that the bridge on the right is a classic special purpose government, and including the bridge and road structures leading up to the bridge. That is a government, and it's separate in this case from the city of San Francisco, and it's separate from the state of California. Now, within each type of fund, there are many different types of funds. So within each category of fund, there are different types of funds, and I misspoke there for a second. So for governmental funds, again, most operations are in the general fund, but there's other different flavors of governmental funds out there. So other governmental funds include special revenue funds, which most governments use for grant activities. And if you printed this out, on special revenue funds, when we talk about it in a little bit, the title of those funds may be changing in the future as well, but we'll leave that aside for today. Capital projects funds are used where a government acquires or constructs a capital asset where it'll use in its programs or services, and debt service funds are just that, to pay for debt service. Permanent funds, which we'll introduce in a second, these are just like endowments but budgeted. And again, we have proprietary funds and fiduciary funds. So let's go a little bit deeper on this, but first, let's go into our next polling question.
We do have one question here.
Yeah.
Why was the name changed from CAFR to ACFR?
Good question. The GASB received notice from actually a different country, in this case, South Africa. And they said the acronym that was being used, and you can sound out CAFR, is actually a pejorative. And it's a swear word in South Africa. And the GASB is a member of the International Public Sector Accounting Standards Board. And in that particular case, they said, you know something, we really got to change it if it is a swear word. And so after careful deliberation and exposure, they released Statement 98 during the pandemic. And Statement 98 just made a quick change. And again, it was to deal with a pejorative. So let me get to the polling question. So here we got governmental activities, business type activities, one major governmental fund, one major enterprise fund, and a discretely presented component unit. How many do you think we got there? And you can almost count the words in between the commas. So it's not too difficult.
All right, go ahead, submit your polling question answer. But Eric, we are sitting at 52% that said 3.
52% 3. Well, the answer is really 5. And again, you had to go back a few slides and count up the boxes. So I have one reporting unit, and again, we're talking about reporting units, which could be slightly different than opinion units. So we have one reporting unit for governmental activities, one reporting unit for business type activities, one major governmental fund, that's 3, one major enterprise fund, which is 4, and one discretely presented component unit, which is 5. So the answer is C. But you're almost there for 3. You just had to get to 5, and then it looks like 26% got to 5. And you can see why this is so important, because again, that goes to the auditor's report. And so preparers really need to understand this as well. Okay, now come on, here we go. All right, we're going to take a little bit deeper dive into fund accounting and reporting. And again, this is good. This is probably where you're going to spend a good chunk of your time as a preparer and as an auditor. And in some cases, many preparers spend their entire careers just working on particular funds. And certainly we work with states where the same preparer is working with the same funds for many, many years. And it really becomes important to understand what goes into fund accounting and reporting. So this is the definition of a fund. And a fund is a fiscal and accounting entity that is separate from other funds. And as a result, fund statements do not provide information about the entirety of a reporting entity. Now, again, funds have a self-balancing set of accounts. The accounts include assets and liabilities, and there are residual balances unless the balance is cleaned out at the end of the year due to law, regulation, and so on. Thus, fund accounting is more than accounting for cash, since it includes other financial resources. Now, governments can create as many funds as they need to comply with legal and operational requirements. Some governments have a limited number, maybe 5 or fewer, but some other large governments like states, they may have hundreds. I think the state of Florida they might have the record. The last I heard, there were over 900 funds. They have hundreds of funds. It's also common for governments to aggregate funds for external financial reporting purposes. So, for example, let's say you got a bunch of funds that encompass federal grant activities. Some governments combine those into a single fund for external financial reporting purposes. So, as long as the law or regulation allows you to do that, that's fine. Funds are used for carrying on specific activities, again, established in law or enabling legislation or attaining certain objectives. Now, only the minimum number of funds consistent with legal and operating requirements, that is the best practice. Just establish the minimum amount you can do. And again, funds can have special regulations, restrictions, or limitations. The regulations or restrictions or limitations are typically specified by, a state constitution or a state statute or a city ordinance, or the individual or organization providing the monies or other resources. And they generally specify or limit the purposes for which the monies can be spent. Now, since funds are individual legal, fiscal, and accounting entities, another feature of fund accounting is that interfund transactions take place. Now, general governments have large central service costs that are allocated at each period close to other programs. The method of cost allocation, it's kind of an inexact science that in some cases is approved by another government, such as a federal agency. The reason why this occurs is to fully cost out goods and services and to not overly burden a federal program. Now, sometimes you may hear this as the process of central service allocation, or you may have learned it as part of a cost accounting class in school. Now, typical allocations could be on the screen, most common of which is, payroll, utilities, legal, budget establishment and operation, compliance, auditing, accounting, payroll. I mention it twice because it tends to be the biggest cost, and certainly other charges. Again, cost accounting is probably an accounting 201 if you never took it. I mean, when I took cost accounting in school, I got C's in it. I'd never really liked it until I actually had to go do it. And then I said, oh, that's not too bad. It's kind of easy to do as long as you know what you're doing. As part of a period close, there are closing entries that then are recognized in what are called due to and due from transactions between funds. Those are basically just receivables and payables between funds. And this is because funds must balance at the end of a period. Now, again, the due to and due from transactions, they're just payables and receivables. But since it's between funds, we need to call them something different. If the payable and receivable is not settled for more than one period, now those turn into advances as long as they're allowed by law. And what advances really are loans. And sometimes these things do take time to, come back. So again, a word of caution on fund accounting. The GASB has been working on modernizing the financial reporting model since, about 2013. Now, yours truly is on the Financial Reporting Model Improvements Task Force. And yeah, it's been a long, strange trip, that's for sure. That said, some of the accounting and financial reporting involving governmental funds, including some of the transactional information I'm going to talk about, say, over the next 45 minutes to an hour, it might change in 2025 or 2026. So you might want to keep that in the back of your mind and stay tuned for a future webinar when we get closer to finality at some point next year. We may talk about the financial reporting model, but we're not supposed to get a final standard out on this until probably during the winter of 2023. So the following are required financial statements for governmental funds. We have a balance sheet and a statement of revenues, expenditures, and changes in fund balances, or some people call that the operating statement, but the proper title is what's on the right-hand side. The balance sheet reports information on current assets, current liabilities, and fund balances. And it's a pretty simple format. Again, assets and liabilities, and if applicable, deferred inflows and in very, very rare circumstances, deferred outflows of resources. And again, keep this one handy if you're the person preparing the governmental fund financial statements. Now, I mentioned a deferred inflow of resources, and what that is an acquisition of fund balance that's applicable to a future reporting period. And a deferred outflow of resources is a consumption of fund balances that's applicable to a future reporting period. Deferred inflows and outflows of resources arise primarily due to the accounting and financial reporting for things like hedging derivative instruments and reporting for things like service concession arrangements. And if you're a lessor, you have a deferred inflow of resources for a lease. But the GASB is the only entity that can tell you what is a deferred inflow or deferred outflow of resources. For governmental funds, deferred outflows of resources are not common, and that's why I didn't put it on the screen. Presentation of deferred inflows of resources in governmental funds, again, mainly relate to grant activity, and in some cases, especially, for example, in the state of Colorado, taxation. Now, there are 5 categories of the residual equity of a fund known as fund balances, and I'm going to talk about that in a bit. On the right-hand side, the statement of revenues, expenditures, again, you got to understand that word, and changes in fund balances report information on inflows, outflows, and balances of current financial resources. And that's the basis of accounting. Major revenue sources in governmental funds primarily are taxes, licenses, permits, intergovernmental revenues, charges for services, fines, forfeitures, and other miscellaneous revenues. Now, within taxes, we kind of know what they are just in our own, individual finances. There are property taxes, sales taxes, and income taxes. Expenditures are detailed by function or program, such as public safety, public services, health, recreation, general administration. And options is to include the department or agency responsible for the function or program. For example, police department, fire department, under public safety, library, education, maybe K through 12 or pre-K through 12 schools. And then activity classifications can also be presented. There's no real right or wrong way as long as it's meaningful. Other financing sources and uses include proceeds from the issuance of debt, transfers, leases that are not short-term, payments to escrow agents for an advance refunding, and proceeds from the sale of capital assets. The financial statement should report proceeds from a debt issue at face value, and we'll talk about those transactions in a bit. But the debt issuance proceeds, that's another financing source. And the face value is reported separately from premiums or discounts. Now, under current GAAP, governmental funds are reported again using the current financial resources measurement focus and modified accrual basis of accounting. The focus of this form of accounting is on the sources, uses, and balances of these current financial resources. Under the current financial resources measurement focus, all transactions involving the receipt or use of these resources flow through the statement of revenues, expenditures, and changes in fund balances. Inflows are reported as revenues or other financing sources when they are measurable and available. Now, sometimes these are defined in policy or procedure or law or regulation, but the guidance is measurable and available. A receivable is reported as a deferred inflow of financial resources if resources are not collected within the current period, but are expected to be received in the future. And again, I mentioned these before. These mainly relate to grants or taxes. And again, I mentioned other financing sources, and those are mainly the issuance of debt or leases that are not short-term, or SIBDAs that are not short-term. Proceeds from the sale of capital assets are also reported as other financing sources if they're material. Now, all outflows are reported as expenditures or other financing uses including capital transactions, principal payments on long-term obligations, accrued interest on long-term debt, uh, you know, uh, capital outlay to purchase capital assets. Those are outflows. Now, fund balance should be reported in classifications that reflect the extent to which the government is bound to honor constraints on the purposes for which the amounts can be spent. And the classifications are non-spendable fund balance, restricted fund balance, committed fund balance, assigned fund balance, and unassigned fund balance. And I'll talk about that in a little bit. An important characteristic of governmental funds is, again, this basis of accounting. And what it results in is a lack of a match between resources and their uses. And it's simply because there's a big bucket of resources coming in the form of taxes or grants. Most governmental funds are supported through what are called non-exchange revenues. And again, taxes, fines, grants, and shared revenues are the main drivers of that. As a result, governmental funds are predominantly subject to budgets that identify the resources available and contain the appropriations to be used for specific programs and services. Now, some governments budget on the modified accrual basis, so it makes the transfer to the current financial resources measurement focus in our financial reports pretty easy. And this means revenues and estimated revenues, they're recognized pretty much on the same basis when they're measurable and available. Now, expenditures are recognized when a fund liability is incurred, and that requires the use of current financial resources. Now, under this basis of budgeting, encumbrances are not considered expenditures. They're recorded as a restriction, commitment, or assignment of fund balance. Now, because of the differences in the basis of accounting between modified accrual and the full accrual basis of accounting in our government-wide financial statements, RAFRs have to have a reconciliation between both of the fund statements and the government-wide statements. Other governments budget on a cash basis or on a regulatory or statutory basis, while a few governments budget using a full accrual basis of accounting. And when you budget on a full accrual basis of accounting, you really got to transfer between what is in the budget and what is in the governmental fund statements. It's almost a backwards looking reconciliation. But again, that's only for a handful of governments that are out there. I mentioned quickly that there are 5 different categories of fund balances. So let's go really quickly through them. Non-spendable fund balance includes just that. These funds cannot be spent because they're not in spendable form. They're not in cash, or they're legally or contractually required to be maintained intact. Again, the not in spendable form criterion includes things that are not expected to be converted to cash, such as inventory or prepaid amounts. It's just not going to, go down to cash. Restricted fund balance occurs when constraints placed on the use of the resources are either externally imposed by creditors, grantors, contributors, or laws and regulations of other governments, or they're imposed by law through constitutional provisions or enabling legislation. And so restricted fund balance can be a pretty large category of funds. Enabling legislation should include a legally enforceable requirement that those resources can only be used for specific purposes stipulated in that legislation. And legally enforceable means that a government can be compelled by an external party, such as the judiciary, to use resources only for those purposes in the legislation. And you do see court cases involving restrictions on fund balance. Committed fund balance, it only includes amounts that can be for specific purposes based on constraints imposed by the government's highest level of decision-making authority. And the authorization is usually in law with the consent of both the legislative and the executive branches of government as it's applicable. Now, the committed amount should occur prior to the end of the reporting period, or else it's kind of, again, being a little bit facetious, but sometimes your legislative body may do funny things. Assigned fund balance includes amounts that are constrained by the government's intent to be used for specific purposes, but are neither restricted nor committed. Now, usually the governmental body, the legislature or the city council, they've delegated the authority to assign the amounts to be used for specific purposes to another entity, such as a budget committee or a finance committee, or in many cases, senior management. So assigned fund balance is pretty important. And sometimes you see a reconciliation between encumbrances, if your government uses encumbrance accounting, and assigned fund balance. And frequently, it involves, gee, we have a contract. And because we have a contract that straddles a fiscal year end, it becomes an assigned fund balance. Now, finally, an unassigned fund balance is the residual classification for the general fund, and it represents the amount that has not been assigned to other funds, and it's not restricted, it's not committed, and it's not assigned within the other categories of fund balance. The general fund should be the only fund that reports a positive unassigned fund balance amount. In other funds, if expenditures incurred for specific purposes exceed the amounts that are restricted, committed, or assigned to those purposes, it may be necessary to report a negative unassigned fund balance. Now, if that occurs, amounts assigned to other purposes are then reduced to eliminate the fund deficit. And if the remaining deficit, eliminates all other assigned amounts in the fund, then guess what? You might have a negative unassigned fund balance in those other non-general fund entities. Now, if your general fund reports a negative unassigned fund balance, either the math is wrong or the government is in serious fiscal trouble. So you really got to be careful on the math on that one. Okay, I mentioned a reconciliation is required between the governmental fund balance sheets that are on the modified accrual basis of accounting and the government-wide statement of net position that is on the full accrual basis of accounting. Now, typically the reconciling items include the elements that are on this screen. So capital assets are reported on the government-wide statement of net position, but not on the fund balance sheet. They need to be reported at historical cost, less accumulated depreciation for depreciable assets, and then added to the reported amount of fund balance. Now, there is a significant discussion going on, gee, how should the future of historical cost accounting, be? And we're probably years and years away from any form of change. But there are some folks who say, gee, has historical cost really outlived its usefulness? If your infrastructure is 100 years old, what sort of meaning does it have on your government-wide financial statements? Long-term liabilities are kind of similar. They're reported on the government-wide statement in that position, but it's not going to be in your governmental fund balance sheet. The balances of long-term liabilities then are subtracted from the amount reported as fund balance on your governmental funds. And then net position is also doesn't report pension and OPEB liabilities or assets. And I misspoke there. Not net position, I meant fund balance. So I apologize. So that's, pension and OPEB liabilities. Those aren't in your fund balances. Revenues that are reported as deferred inflows or resources on the fund statement, those may need to be adjusted to your government-wide financial statements because of the time element and the difference in the basis of accounting. So you might have a deferred inflow of resources in your fund balance, but because of the full accrual basis of accounting, it's reported as revenue in your government-wide financial statements. And sometimes you see that in taxation. Internal service fund assets and liabilities need to be added and subtracted respectively from the reported amount of fund balance based on the fund activity as it relates to governmental funds. Now, the second reconciliation, come on, let's go. The second reconciliation also occurs between the statement of revenues, expenditures, and changes in fund balances for governmental funds as well as the statement of activities in the government-wide statements. Now, typical reconciling items are the debits and credits that are the opposite of the reconciliation that is in between the balance sheet and the statement of net position. So again, we're talking about capital outlay. We could include proceeds from the sale of capital assets. Depreciation, of course, is not reported in the governmental fund financial statements. The payment of debt service is reported differently in the statement of revenues, expenditures, and changes in fund balance because principal retirement is reported as expenditures on the fund statements, but it's a reduction of a liability in the government-wide statement of activities. Now, there could be increases in long-term obligations for things like compensated absences, net pension liability, net OPEB liability, claims and judgments that are not reported in the fund operating statements since they don't require a use of financial resources. And those unreported expenditures need to be subtracted from the change in fund balance. And there are other categories that could result in a reconciliation. And so keep this in the previous slide handy if you're the person who's in charge of preparing the reconciling items, because guess what? A lot of auditing goes into these reconciling items. For governmental funds, again, GAAP limits the availability period for specific categories such as property tax revenue. And in this case, in property taxes, it's no more than 60 days after the end of the fiscal year, unless circumstances justify a greater period. Now, if so, this is disclosed in your notes to your basic financial statements. Now, the period of availability for other revenue may be more than 60 days, but only if it's received soon enough after year's end to pay the reported liabilities. However, governments are encouraged to use the same period of availability for all revenues, but you see some different things, depending on the government that you're preparing or the law, regulation, and so on. And again, you should disclose this period of availability in your notes. Revenues not received within the availability period are reported as a deferred inflow of resources in the fund statements, and they're recognized when the period in which it becomes available. But in most cases, it's when the funds are received. Most governmental fund revenues are generated from fees for services in non-exchange transactions, which include 4 different categories related to taxations, grants, and other contributions. And I'll delve into those in a little bit. But first, we got to get into our next polling question. So let's see what this is. All right. Which of the following balances would not likely have a reconciling item between a balance sheet and a statement of net position?
Right. Well, we're waiting for you to answer. Quick question here. Is unassigned the same as unrestricted?
Not exactly. Unassigned is in the governmental funds, and unrestricted is in the proprietary funds or the fiduciary funds, which we'll get into in a little bit. Well, actually, fiduciary funds do not have unrestricted. They're all restricted by nature, so I apologize. It's really in the proprietary funds. Now, somebody else said, can you explain the difference between unearned revenue and deferred revenue? Also, revenue earned but not received versus cash received and not earned yet. Okay, so we could talk probably an hour and a half on those. Unearned revenue, by the way, is not exactly a GAAP term. However, there are organizations out there that do use it. Unearned revenue mainly is involved with insurance entities in governmental and state and local governments. But by and large, the general purpose government should not be using unearned revenue. Deferred revenue also it no longer should be used for governmental state and local governments. And that's due to a change that occurred about 10 years ago with GASB statement number 65. You should either use in advance or deferred inflow of resources if the GASB allows it. And so, but again, We could spend an entire webinar on that. Also, revenue earned but not received versus cash received but not earned yet. Okay, so revenue earned but not received, that would be a receivable. Cash received but not earned yet, that actually is a liability. Or an advance that is presented in your governmental funds or your government-wide financial statements. And so there is a difference. One is a receivable and one is a payable. Good questions. All right, so let's get to our polling question. Let's see. All right, folks are awake. Indeed, the answer is D. If you see a difference between the total of your fund statements and the in cash and the cash that is on your government-wide financial statements, something's wrong. Now, I'm not including fiduciary activities. Let's leave those aside. But cash should be the same between your proprietary funds, plus your governmental funds, and your business type activities and your governmental activities on your statement in that position. If it's different, we got some explaining to do. All right, good thoughts, folks. All right, so let's get back in the webinar here. I got to pop this one down. All right, we got to keep going here. All right, so I talked a few seconds ago that non-exchange transactions have 4 different flavors, and they could be either derived tax revenue transactions, imposed non-exchange revenue transactions, government mandated non-exchange transactions, or voluntary non-exchange transactions. Now, again, keep this one, bookmarked or dog-eared or however you want to do it. But really quick, derived revenues result when a government imposes a tax on an exchange transaction. So let's say you go buy something on the way home today, or you work for an hour today. Now, in many jurisdictions, when you buy something, you got some sales tax. Or if you work, you got some income taxes. Now, under the accrual basis of accounting, derived revenue should be recognized net of estimated refunds and estimated uncollectible amounts when the exchange takes place or when the resources are received, whichever comes first. So when that sale occurs, that's when you got some revenue. Under the modified accrual basis of accounting, derived tax revenue should be recognized in the period when the exchange takes place, provided that that revenue is available. Now, imposed tax revenues are taxes and fines based on an act that is committed or omitted, such as, okay, I bought a house. That means I own property, and I am committing I did a transaction. That means I owe some tax. Or I sped on my way home, and that means I broke a law because I got flagged down by a trooper. And now that act is not an exchange. Now, as with other types of non-exchange transactions, revenues are recognized net of, again, estimated refunds and estimated uncollectible amounts. So for governmental funds, for these 2 types, basically revenue is recognized for the amount received during the year or shortly thereafter. And there's that 60-day accrual standard. And most governments use this 60-day accrual period for all types of revenue because it makes things a little bit easier to understand. For other funds and the government-wide statement of activities, revenue is recognized when there's an enforceable legal claim. Now, taxation is also known as levying. And again, you may have learned that in your business law class, but beyond the scope of today. So the other 2 types of revenue transactions that are non-exchange, they occur really when, in the first case, the government mandated non-exchange revenues. That's when, a government at one level provides resources to a government at another level, and there's some strings attached to it. So usually these are grants. And if the grant is accepted, the purpose, the government receiving the revenue, they need to use resources for a specific purpose or somehow, some way the purpose established in the enabling legislation. So you got to use it for education. You got to use it for transportation. You got to use it for public safety, or else you're in violation of the law. And that's a government mandated non-exchange transaction. Voluntary non-exchange revenues result from contractual agreements, either completed willingly, by two or more parties, or in some cases, the legislative body may engage in a voluntary non-exchange revenue transaction. Government mandated and voluntary non-exchange revenue transactions mainly consist of grants, entitlements, shared revenues, payments received from other governments in lieu of taxes. Regardless of the classification, revenue is recognized when all the eligibility requirements have been met, subject to the availability criterion in governmental funds. Now, grants may have any number of eligibility requirements for compliance purposes. For accounting and financial reporting purposes, eligibility requirements really focus on who you're supposed to provide services to, or whether or not matching resources are required. And there are many, many other flavors of these that we can talk about for another webinar. But by and large, these revenue transactions mainly involve grant awards. The provider may also specify purpose restrictions, which again dictate how the resources may be used. And again, they involve many aspects within a federal grant award. So, for example, let's say funds from a law enforcement block grant may state it can only be used for law enforcement purposes. A community development block grant may state it can only be used to encourage low-income housing or to spruce up blighted areas. So the focus on revenue recognition is whether or not the government meets its eligibility requirements. Otherwise, the costs could be what are called disallowed and a liability is declared. And again, we could easily spend another 2 hours just on these 4 types of non-exchange transactions. So let's go back and talk a little bit further about governmental funds. Again, the most important governmental fund is the general fund. The general fund should be used to report all flows and balances of current financial resources, except those that are required to be reported in some other fund. It is the default fund. And if a resource does not belong to another fund, it goes into the general fund. And unlike other fund types, if a government has more than one general fund, it is not in accordance with GAAP. No way. You can only have one general fund. Now, special revenue funds should be used to account and report for the proceeds of specific revenue sources other than capital projects that are restricted or committed to expenditure for specific purposes. The term proceeds of specific revenue sources establishes a purpose restriction or a commitment, and that's the foundation of a special revenue fund. And those specific or restricted committed revenues may be initially received in another fund and subsequently distributed to a special revenue fund. And by the way, this is one of those things where the caution tape is out. The name of special revenue funds could be changing in the next 4 or 5 years. Capital projects funds are used to account for and report financial resources that are restricted, committed, or assigned to fund capital facilities and other capital assets, other than those financed by proprietary and fiduciary funds. Fiduciary funds is pretty rare to do capital projects, but proprietary funds do capital projects often. Generally, the use of capital projects funds provides for efficient management of resources that goes from year to year to year, especially in large construction projects. Debt service funds are used to account for financial resources that are restricted, committed, assigned, and so on, just to pay principal and interest. Financial resources could be in those funds to pay for future debt service, and that's fine. However, not all governments are authorized to have debt service funds. When I used to work for a state government here in the Northeast as a preparer, I was deputy state controller. The law did not allow us to have debt service funds. And so as such, that debt service activity showed up in our general fund unless it was required to be in another fund, such as a special revenue fund or a capital projects fund. If not authorized in law, the general fund, again, usually reports debt service. Finally, permanent funds are most commonly used when governments receive donated resources to be invested by the government. The donation restricts the use of resources so that only the earnings and not the principal may be used for activities that benefit the government. A permanent fund is used to account for that activity. In other cases, the sale of government property, within the jurisdiction of the government may trigger a permanent fund. And the key is that the government establishes and benefits from those programs. So here's a good example. The state I used to work in had a permanent fund, which when we were implementing the current financial reporting model, which was implemented in 1999 to about 2006. And it took a while to implement. We did a bunch of research, and we had a permanent fund that dated back to 1821 from the sale of, well, I work for Massachusetts, and back in 1821, the state of Maine became its own state. And in response to the state of Maine splitting off from Massachusetts, a $5 million payment was paid to the state of Massachusetts back in 1821, which was a lot of money back then. And so that $5 million has sat in perpetuity for the last 200 plus years. And the interest off of that is used to fund K through 12 education. But the principal, that $5 million, can never be spent. And that is a perfect example of a permanent fund. Most administrative services of a government should be accounted for again in the general fund. These services include the executive, legislative, and judicial branches of the government because they provide supervision to all the activities conducted by the government. These services may include human resources, finance, administration, facilities management, and other overhead costs that contribute to the delivery of programs and services that to the general public. Now, the list below here certainly is not an exhaustive list. Your government's financial statements may include a lot more programs and services that are on this list. So by all means, take a look and see what's there. And then take a look at your annual financial report and you'll see the differences. And again, the general fund commonly also includes transfers of resources to other funds. And of course, to establish other funds, it may make permanent transfers. It may also make permanent transfers outside the general fund or even outside the government, and that's in the form of a subsidy to another entity. And frequently you see that in the establishment of a component unit or subsidizing of a not-for-profit and so on. And sometimes that is required to do so within law, regulation, and so on, or even in a federal grant award. The most compelling criterion for the use of special revenue funds is the need to, again, segregate revenues and balances outside the general fund. And although these restrictions can be accomplished using a pretty good accounting system and a good chart of accounts, there are other administrative reasons to report separate funds. Now, special revenue funds are most commonly, again, used to account for federal and state grants. And I like to shorten things to what's called SRFs. And so SRFs may also be established for things like special assessments and other activities. Resources may be restricted by either the government's legislative authority and enabling legislation or by a third party, such as a grantor or, say, a bond indenture. Now, SRF revenues can include tax assessments, earmarked resources, other revenues such as intergovernmental revenues, licenses and permit fees, or charges for services. Expenditures reflect the nature of the programs for which the resources have been restricted, and it could include personnel, operating expenditures, capital outlay, or even debt service where a government does not have the authority to establish a debt service fund. Now, there could be some instances where special revenue funds indeed have debt service. In some instances, you do fund long-term construction projects within a special revenue fund, but the resulting capital asset does not belong to the government. So let's say the government of a state constructs schools that eventually belong to a school district. Well, if it's not accounted for in another fund, it's probably accounted for in a special revenue fund because it can't be in a capital project fund because by definition, capital construction results in a capital asset of the government. But it frequently does occur where larger governments construct projects or acquire capital assets for other governments. And you see that a lot, especially in state governments. So those are special revenue funds. Generally, the use of capital projects funds, again, provides these resources for large multiple year capital projects. The construction of a governmental office complex or a bridge, as it shows here on the screen, that's an example. Another would be, say, a large recreation center complex financed with general obligation bonds. And capital project revenues typically include, issuing bonds, and you have bond proceeds in there, which are other financing sources, intergovernmental revenues, interest income, earmarked taxes, transfers of other funds, and in certain cases, grants. Expenditures generally include capital outlays and any other project costs that are tied to that particular capital project. Now, some governments have one capital project fund, and other governments have a multitude of capital projects, depending on the complexity of the capital projects that are undertaken. When I had a state government, I think we had about 10 capital projects funds, and we tried to segregate it by different types of capital projects for infrastructure, for technology, for buildings, and so on. And it's really up to the policies and procedures, laws, and regulations of a government as to how many capital project funds that are established. For debt service funds, the key is whether they're authorized in law. Now, some governments, again, do not allow debt service funds. And if allowed, then the elements of a debt service funds are pretty simple. In revenues in debt service fund, they may come from earmarked taxes and investment earnings on balances that accumulate in the fund. But resources are really most often transferred from other funds, such as the general fund. And expenditures include principal and interest and other related servicing fees. Now, the modified accrual basis of accounting recognizes as expenditures only that portion of debt service that is due and payable. And this represents one of the modifications to the accrual basis of accounting that's on that reconciliation sheet. The permanent funds, again, they're mainly endowments created by donations, but the government is the beneficiary, not anybody else. And that's an important aspect. And again, government is the beneficiary. And in some cases, the fund is even budgeted. If the government was not the beneficiary or the beneficiary was somebody outside the government, then a private purpose trust fund is used. And let's see, and that leads us to our next polling question. And let's see if you're awake. And with that, I'm going to take a look. Okay, so somebody asked, what are the benefits of moving pieces of the general fund to a special revenue fund? Well, the benefits of that, there may be in a grant award requirement for matching funds. And typically those matching funds are provided by the general fund because they're appropriated from the general government resources. And as such, you get a transfer in from the general fund to a special revenue fund. And that then the special revenue fund can finance the programs and services along with the grant award. And so that's a great question that was asked. So
all right. We'll leave the poll open. Go ahead, submit that. But we are sitting at 45% with option B and 39% with option C.
Well, in this case, no, it's not. No, it's definitely not D. So a few of you did B and a few did C. And I threw that one in to see if you're awake. Now, this one actually has two different answers. And indeed, those of you who selected either B or C, you got it right. This one could be either, as it could be a stabilization account, and in many cases, that is a special revenue fund, or it could be a permanent fund. It depends on the law or regulation that establish things. Okay, so let me get this off. There you go. That word permanent kind of threw you off. But again, depending on the law or regulation that established the rainy day fund or stabilization fund, either way, it could be a special revenue fund or a permanent fund, or actually in some cases, it could even be a subset of the general fund. Okay, let's keep going and let's talk about proprietary funds. Here, come on. All right, let's talk a little bit about proprietary funds. And again, you may remember from the top of the webinar that these are just like a business or a not-for-profit, and they use full accrual accounting just like those entities, with some certain twists and turns, of course. Now, there are two types of proprietary funds. Enterprise funds may be used to report any activity for which a user fee is charged to external users. And that word external is important for goods and services. And that phrase external users is vital to tell the difference between the types of funds. Now, the most frequent use of enterprise fund accounting is for public utilities such as sewage treatment, electric, water, solid waste collection. And there you got a fee charged to each customer, water, sewer services, electricity, and so on. But there are many, many other variations of it. For example, municipal golf courses, recreation centers, summer camps, emergency medical services, public hospitals, public universities, public sector risk pools, public transit, athletic arenas, and convention facilities. The activities of enterprise funds, again, are typically reported as business type activities in the government-wide financial statements. And oh, by the way, since it's on the same basis of accounting, unless there's an internal service fund transaction which changes the balances and results of operations a little bit, there's usually not many reconciling items in between an enterprise fund and the business type activities that are in the government-wide financial statements. Internal service funds account for the financing of goods or services provided by one department or agency to other departments of agencies of the government, or to other government units on a cost reimbursement basis. Again, the reporting government must be the predominant participant. And the government is the primary participant in these funds. They are essentially selling to one another within the government, and they allocate all these internal costs on the screen. And we'll talk about it in a little bit. Proprietary funds, they report just like a not-for-profit. They use a classified statement of fund net position, and it has current and non-current assets and liabilities, just like a not-for-profit. A statement of revenues, expenses, and changes in fund net position. And again, I said expenses because we're not talking about a government fund or governmental fund. It also has a statement of cash flows, again, prepared on a direct method. Expenses are full accrual, and that's why we use expenses and not expenditures. But again, realize that internal service funds are different than enterprise funds. And so again, refer back to the previous screen here. You have two different flavors, enterprise funds and internal service funds. One sells to the government itself, and that's the primary customer. The other, enterprise funds, sell to everybody external to the government. Okay, let's talk quickly about fiduciary funds. Now, there are likely at least 10 hours of webinars over the last 4 years, which Amy and Allie can point you to on YouTube from Eide Bailey, all talking about fiduciary funds and fiduciary activities. I could again talk for hours and hours and hours on end because the gap on these changed over the last few years. I'm not going to delve deeply into those elements. You can watch them on YouTube, but let's just skim the surface. And if you're doing a search on YouTube, just take a look for GASB statement number 84 or fiduciary activities in Eide Bailey, and there they'll pop up. So fiduciary funds are only reported in the fund financial statements. They're not reported in the government-wide financial statements. Now, if you do have fiduciary activities, the different types of fiduciary funds are reported in the basic financial statements, and they include the following 4 types that may be applicable to your government. And you have pension and other employee benefit trust funds, and these require an irrevocable trust, and they may be defined benefit or defined contribution programs and plans. And these are your defined benefit pension and defined benefit health care, but you also might have defined contribution pension and health care as well. Investment trust funds present the external portion of investment pools where investments are not the government's own investments, but they're managing and administering investments for other entities. The pool may report at fair value unless it elects to report at amortized cost by disclosing that they're at cost and complying with some very narrowly defined provisions within GAAP. Now, I mentioned the phrase private purpose trust funds a few minutes ago, and they include all fiduciary activities that are not pension and other employee benefit trust fund arrangements or activities required to be reported in investment trust funds, and they're held in trust. And again, these are not permanent funds, even though they include bequests and other arrangements where the use is restricted. Again, that difference is the beneficiaries for private purpose trust funds are for folks outside the government or organizations outside the governments. And that is the key difference from permanent funds. Internal Revenue Code Section 529 called savings plans or 529A able plans. They may be reported as private purpose trust funds by states, or they may be reported as part of standalone financial reports, but they use the fiduciary model. Finally, custodial funds report fiduciary activities that are not required to be reported in the other types of fiduciary funds. Subcategory of the custodial funds report those few situations where an external investment pool does not have a trust or equivalent arrangement. Now, a common example of custodial fund activities include taxation collected by one government and then provided to another government with no further administrative involvement. Reporting for fiduciary funds is really easy. It includes full accrual accounting, and it has a statement of fiduciary net position and a statement of changes in fiduciary net position. All net position is restricted. But that leads us to our next polling question. Okay, let's see if you're awake. Okay, which of the following activities is likely presented in an enterprise fund? Would it be a budgeted fund that includes the construction of an asset, county water sewer system, where we have ratepayers, repayment of debt service, or the information technology function of a city? What's probably in an enterprise fund?
And currently 74% said a country water/sewer system where ratepayer.
Yeah, the county water sewer system. Yeah, that's where all your water sewer bills go. That goes into an enterprise fund into your county. And so B is the answer. And so those of you who answer B, you won the wager. And so congratulations. Okay, armed with new knowledge about governmental funds, proprietary funds, and fiduciary funds, let's take a look at how some transactions are posted in state and local governments, and you might be a little bit surprised. So other than the individual line items on a trial balance, I discussed the reconciling items involving the major changes in postings between governmental funds and the other types of funds and activities a few minutes ago earlier in the webinar. And again, the big dollar amounts usually involve debt and capital assets and may involve, of course, pensions and OPEB, but it really is government specific. There are other transactions that mainly involve recording of accruals, eliminations for double counting, closing of internal service fund transactions and balances, and other accrual period adjustments. Now, We do not have time in this webinar to go through the multitude of potential adjustments. So I'm just going to focus on the two biggies, which is debt and capital assets. Now, maybe once we get closer to the new financial reporting model later next year, maybe we'll go down and take a look at the differences between current GAAP and the new financial reporting model once we get there. But let's hold that thought. And again, we could do an entire webinar or even a workshop where we do things in person, just going through the differences in transactions. So let's say we're going to build a school and we have some issuance costs because, gee, we got some legal and banking and financial advisory services. And as we know, our lawyers, bankers, and investment advisors, they're not free. We wish they were, but they're not. Now, since we're a school district and the school will be a capital asset, and again, hold that thought, we're going to account for this in a capital projects fund. Now, notice the debits and credits are eerily similar between the governmental funds and the government-wide numbers, except for one big number. And that kind of sticks out like a sore thumb, doesn't it? At sort of in the middle of the screen. So instead of an other financing source, which is an inflow or revenue in a governmental fund, on the government-wide or full accrual financial statements, we have bonds payable. That's a liability. So we're converting from a revenue to a liability, and gee, that's where your reconciling entry falls out. So also notice the change in text from expenditure to expenses. And again, I'm assuming that there's no accrual adjustments that we need. We're trying to keep this, easy peasy. And boy, we better not have a difference in cash. That's for darn sure. And we're also assuming there are no dangling accounts payable, of course. So, all right, so keep this one handy. Okay, so let's keep going. Let's say we're going to pay some debt service on those bonds, and notice those debits and credits again. Obviously, cash, if you have a difference in cash, I want to have a chat with you. But the cash should be the same on that. Notice the debits and credits. So on the debit side, we have some text change and no retirement of debt because the debt sale was a revenue in the previous screen. Now, also remember, if I don't have authorization for a debt service fund, I can use either the general fund or the capital projects fund for my debt service. It's really up to your law and regulation in your government. So my credits should be the same. My expenditures for interest should be close. I mean, there might be some accrual adjustments. And my expenditure for principal, that should tie to my retirement of bonds payable. Now, again, there could be some accrual adjustments out there between the government funds and the government-wide. Okay, so let's keep this up. We're going to build the school, and we have $243,000 in construction costs during a month. Now, notice my debit for the capital projects funds, and you'll see this plenty of times in your career, and certainly as part of this project. Okay, so I got a debit for $243,000 and change, and that says expenditures, outflows, capital outlay, and my credit is cash. And again, my cash better be the same. Okay, but now look at my government-wide. I need to reclass that from a outflow or expenditure to a construction in progress. So now you can see the reconciling entries aren't all that difficult until you see how many of them you might have to make. So again, pretty easy to make. Now at the end of construction, we're going to get rid of our old school. We're going to sell it to a separate not-for-profit for $400,000. Now let's just say we did not declare this as an asset held for resale, which may have been done. And notice my credit in the government fund. It's probably the general fund. Okay. So my credit is to an other financing source. Now, why? Because I don't got capital assets in the governmental funds. Now let's look at the full accrual financial statements. On the right-hand side, since I got capital assets and I got some depreciation, I got to do some math. So just like a not-for-profit, I got to remove the accumulated depreciation and the historical cost for the land and building. Now, what falls out is the loss on disposal, and that's that $690,000, which shows up in my government-wide financial statements. And again, there's going to be a bunch of reconciling entries because in my modified accrual financial statements, I don't have any capital assets. But on the right-hand side, I got a lot of other stuff that, that needs to be declared. So again, this is just a really quick overview of what we could spend days on, or at least one day on the differences between governmental funds and the full accrual basis of accounting. Okay, so let's transition to auditing to wrap up the webinar. And as you may or may not know, auditing in governments, you got at least 2 or 3 hours plus of CPE to really understand the basics of auditing in governments. And so we only have about 20 minutes left or so. And so, auditing is a little bit more than a government 101 course, but it's not that far afield from what you learned in your auditing classes in school. So let's keep in mind a few things. Government audits use the same basic set of financial auditing standards as non-governments, unless there's a specific exemption in gas, or the standard doesn't apply. As an auditor, for the Code of Professional Conduct, Part 0, or the preface to the code, applies. It also applies to those of you who are CPAs in government. You may not have realized it. You got to apply the preface. Part 1 of course, in the Code of Ethics applies to those auditors on the webinar. Those of you who are CPAs in government and are preparers, you apply Part 2. Yes, you not only have to apply AICPA standards, but you also may be subject to the state ethics rules. Government auditing standards applies to most governmental audits. The requirement for governmental auditing standards it is contained in grant award agreements, laws, regulations, or contracts. Generally accepted government auditing standards, or GAGAS, is on top of GAS, or in some cases, rare cases, some internal auditing standards. Now, we could have at least 4 hours just on the various aspects of GAS and GAGAS we see in governments, but again, way beyond the scope of today. And then finally, we have the single audit. That is a federal law dealing with federal grant operations within subpart F of the law, that is on the screen. That's Title II, Code of Federal Regulations, Part 200. And there's a separate subpart which governs the single audit requirements, and that's subpart F. The application of these 3 sets of guidance differs depending on facts and circumstances. Of course, GAS applies where you're engaged to have an audit. If an entity does not engage in an audit, then attestation standards may apply. It really depends on the type of engagement that a government has. Now, if an auditor is engaged to perform an audit in accordance with GAGAS for either a government, or in some cases a not-for-profit, or in a very limited amount of cases a for-profit entity with government contracts, then GAO standards apply unless the federal funds are above $750,000. If federal awards are more than $750,000, then all the standards apply, including the single audit. And so, again, keep this handy. Your audit may have more than one level of auditing involved. The easiest way to think of auditing is like our magic pyramid. Since a single audit is a law, if it's applicable, then it's got to be performed. And in any case, you may or may not know there's a supplement that's issued by the White House Office of Management and Budget called the Compliance Supplement. The supplement compiles a list of compliance requirements and federal awards based on risk, as well as the terms and conditions of federal grants. Many grants have common terms and conditions, and therefore the audit and reporting of these grant activities are known as clusters. By aggregating all those activities and taking a step back, guess what auditors on the webinar, you're performing the compliance audit of the United States of America in conjunction with the General Accountability Office. That is where the reporting on these activities ends up. And if you think about that for a second, what all of us are participating in, it's pretty important. Now, due to the differing scope, there are different elements in each audit. Of course, evaluation of internal controls is the cornerstone of every audit, but testing is not required unless there is some form of risk. Compliance testing is only required where there is a risk of non-compliance resulting in a direct and material impact on the financial statement. For the single audit, the focus is on the major programs, which involves risk assessment and analysis of what is required in the compliance supplement that's issued by OMB every year. Given that we are evaluating compliance, each major program has a lower threshold of materiality than what might be involved in a financial audit. Now, due to the force of law, an entity either complies or doesn't. This means in some cases, materiality may actually be zero. Due to these differences, different reports from the auditor are produced. Now, if the auditor is engaged for a GAGAS audit, then a report in accordance with government auditing standards is included. For the single audit, a schedule is produced by the entity reporting the schedule of expenditures of federal awards. Now, notice I said the word schedule. It's not a financial statement, and its title, again, is a Schedule of Expenditures of Federal Awards, or CFA. A report is included on the schedule, as well as a report on internal controls and compliance applicable to each major federal program and internal controls over compliance in accordance with the uniform guidance. Now, where does this all end up? These reports are filed with the Federal Audit Clearinghouse, which is an arm of the U.S. Census Bureau. The reports are compiled by federal agency, and the federal agencies react by updating the following year's compliance supplement. Now, in some cases, they don't react for a while. In other cases, they do. It really depends on the federal agency. Now, let's talk for a few minutes about compliance. Again, since we're working with a law, either one is complying or one is not. So again, we're driving home tonight. If the law states that the speed limit is 25 and you got a lead foot and the traffic camera captures you going 40, you're not in compliance and you get a ticket. You pay your fine, or you can contest it before a judge and you may win or lose. The single audit is kind of the same thing. The federal agencies issue the compliance guidance beyond a basic set of provisions in the uniform guidance. It is a federal regulation, meaning it is a law. These compliance elements are mostly based on risk and legal provisions. This means that the materiality threshold must be in accordance with the law. So again, let's think about our speeding ticket. Now, technically, I know what you're saying. You know, there's a 10% variance usually in most jurisdictions, but you know something, you are speeding if you're going 26. You either comply or you don't. And therefore, there are more stringent audit provisions. There are other differences, especially for GAGAS and CPE and so on, in governmental audits, especially for audit managers and above. GAGAS also may involve three-party audits, and this is unheard of in for-profits or not-for-profit. So what's a three-party audit? It's when an oversight body, typically a state auditor, engages an independent auditor to perform a piece of a larger audit. That is common. And finally, even the terminology is more stringent. You know, if you've gone through your ethics training, you know the words must and should from the Code of Professional Conduct, those of you who are CPAs. But given the force of law, the word must really means you got to do it. No wiggle room. So in any event, that's some of the other key differences. So there's some other differences. And again, you know, stick this on the cubicle wall if you're a first year auditor or you're the person who is really involved with interfacing with those auditors. There are differences between what is going on in the Code of Professional Conduct and what's going on in government auditing standards and what's going on in the uniform guidance regarding the same terminology. Now, look at the differences and where something is mandatory or required and where a word is just not defined. And you see that in the lower right-hand corner there, which is really kind of interesting. And that leads us to our next polling question. Somebody asked, what's the benefit of using an internal service fund other than capturing costs? There are times where you must use an internal service fund. Well, in my government, when I was their preparer, we technically did not have law that allowed an internal service fund. We called it an administrative control fund, though, because we set it up administratively. But it was an internal service fund. The benefit of doing that is you can fully cost out central service costs. And many general government costs are allocable, meaning your audit costs, meaning your accounting costs, meaning your budgeting costs, your general overhead costs, your technology, your copying, your legal, and so on. And as such, why charge the general fund all of those costs if another fund can pay for those costs? Especially in many cases, a federal grant award will pay the indirect costs of a program. So it's a good thing to fund it for budgetary purposes, at least through an internal service fund. And so that's a good question to ask, and thank you for asking. All right, where are we at?
60% are saying option B, 33% option A.
Yeah, it is option B. It's not subject to a single audit unless it's directed by the terms and conditions of the federal award. But by the way, there is a brand new attestation engagement connected to the American Rescue Plan that would fall under number 2. And it's an attestation engagement. It was a negotiation that was worked out between the ASCPA and the White House Office of Management and Budget for American Rescue Plan dollars that are less than $750,000 to get some coverage in addition to a financial audit. So again, beyond the scope of today's course. So, okay, good work, folks. Okay, now that you understand the differences, here you go. Now that you understand the differences, in the audits, why are government audits different? Well, if you were here in September, you remembered one word I kept going back and back to, and I haven't mentioned it much today, so we got to keep going on what I mentioned often in September. It's that magic word, accountability. Each program, service, activity fund of a government has some form of accountability to some entity. And of course, our grant activities do as well. And ultimately, the accountability is to all of us, meaning you and me. Now, due to this word accountability, the auditor's report of a government is got to be different. It's structured on those opinion units I talked about in the first hour. And I also talked about them back in September. Fundamentally, separate audits occur for the core governmental activities of a government, activities where the government operates like a not-for-profit or business, and entities related to a government but legally separate, and then immaterial activities in the aggregate. And that goes back to that exhibit that we talked about in the first hour from the ASCPA State and Local Audit Guide. Remember, governments are different due to these opinion units. Multiple statements of net position, multiple statements of activities, and in some cases, statements of cash flows are generated. In some cases, audits may be performed by multiple auditors. Remember the potential for three-party audits I mentioned a few minutes ago. For example, there's a very large city on the West Coast that has, I think, a dozen auditors working in various aspects of the city audit, and all report up into that level. So it really is like herding cats. There are many more group audits in governments than there are in not-for-profits. For-profit entities may have a group audits, but really only if they have international operations or a conglomerate. Materiality then is based on each opinion unit, excluding other opinion units. Now, in many governments, there may be 4 or 5 materiality calculations performed, or even more. It really depends on the complexity of the government. The opinion units stand on their own and there's no combining going on. Now, we could easily spend many 8-hour days discussing federal grant operations, accounting, and auditing. We all know as citizens that federal awards are important in our communities, but there are strings attached to most federal awards, including administration, operation, and compliance. Now, most of these provisions are decades old, but they've been modernized in various ways throughout the years. Before a regulation is enforced, it's proposed through a rulemaking process within the Federal Register. And you read about that in the newspaper, you hear about it, that some federal agency has proposed something, a new federal rule for something. And you hear about it almost every single day. And this is actually delves back into a decades old process. Before regulation is enforced, it has to go through this rulemaking process within the Federal Register, and they have to receive comments and react on those comments. And once all those comments are adjudicated, the Federal Register gets published, and those are the new rules or regulations. Now, those regulations can be overturned by the courts. And again, you read about those every day where somebody has appealed a regulation to a federal court, or it may go to the Supreme Court. Or there may be new regulations that are approved by a new administration that overturns the old regulations. So as you can see, it's a pretty complex process. So the uniform guidance has 6 parts plus appendices. Governments that are awarded grants and their auditors need to understand the elements of each part, the appendices, and the annual compliance supplement as it applies. But we don't have that time today. And again, you could easily spend 8 hours of CPE just going through all 6 of these parts and the appendices. And we just don't have the time today. Nearly every federal agency has some impact on a federal award once Congress approves the funding and the president signs it into law. Each agency has this regulatory language. The inspector general in each agency has some post-audit responsibility. And oh boy, inspector general, they're pretty busy folk. And of course, they not only have post-audit responsibility, but they're doing a lot of other stuff. Now, the White House Office of Management and Budget gathers all the compliance requirements annually, and they publish them in that compliance supplement. Auditors then audit based on the compliance supplement provisions at the grant award recipients or at these entities called subrecipients, which again are beyond the scope of today, but we may talk about them a little bit in our November webinar. The GAO audits the federal government, which is based on audit risk information from the results of all federal audits as filed to this federal audit clearinghouse, and that's part of the U.S. Census Bureau. So if you really want to know, what your city or town or state is doing with your federal funds, go take a look at the Federal Audit Clearinghouse. It's freely available to every citizen in America. And it's really kind of interesting stuff sometimes. So officials are at each federal agency that has federal awards with roles to administer the programs. The agency's single audit coordinator has a goal of preventing fraud, waste, and abuse. They follow up on audit findings at auditees, and they also actually check on us auditors. Due to the federal programs relating to the pandemic, these folks have been really busy lately, especially the folks at the U.S. Treasury, U.S. Department of Health and Human Services, and of course, U.S. Department of Labor with unemployment compensation. There are also the single audit accountable officials at each agency. These managers oversee a collection and a collaboration of auditees to increase the quality of the audit and to assist in audit finding resolution. In other words, they're your help desk. They are there to help alleviate findings. They work with the key management single audit liaison, and the liaison is the initial point of contact for auditees. Now, states may have a familiar setup as they routinely again pass grant awards through to other entities that where there is some accountability measures. These other entities are subject to the accountability. They're known as subrecipients. And again, beyond the scope of today because we can talk for hours about subrecipients, and we will. These subrecipients can be governments or non-governmental entities. And so this leads us to our next polling question. And remember the pictures I had on the screen a couple of minutes ago. All right.
Sitting about 70% that say option C.
That is correct. All right. So option C is indeed correct. Yeah, insurance risk pools, they don't really look at the result of your single audit, but they may look at other financial data, especially for, claims data and so on, that may be in a financial audit. So that's a good thing. But the other three, yeah, they're parties to single audit. So let's keep going because we're heading in the clubhouse turn here. Okay. So so what's included in the single audit? Now, unless there are some other risks involved by the federal agency requiring an audit, we got that $750,000 threshold in a fiscal year. Now, in a handful of cases, biennial audits are allowed if the government had a biennial audit before 1987, but those are only, you can probably count on a couple of handfuls. Auditees can be nearly every organization, including a few for-profit entities that mainly deal with the Department of Defense and actually Department of Transportation as well. Now, a federal award includes financial assistance or cost reimbursements, again, mainly relating to DOT or DOD. Now, federal programs are listed in what's called a catalog of federal domestic assistance. And it's kind of like the old Sears catalog, but it has every federal grant. The catalog is published on a website called grants.gov. Now, some federal programs, again, are clustered, and that's important for audit purposes. And clusters are closely related programs with common compliance requirements. The goal of a single audit is to have standardized compliance and standardized reporting. Now, why is the word uniform, is it meaningful? Well, yeah, no. Many agencies have their own rules and regulations, the biggest one being HUD, having their own audit guide. And we won't even get into DOD, because if we had to tell you about DOD's audits, we'd be breaking a lot of laws and regulations. But, and I'm making a joke there, but there's a lot of secretive stuff going on at DOD and Homeland Security as well. Medicaid and student financial aid audits, they take special skills that first-year auditors may not have. But by the second year, yeah, you should be okay. Now, there may even be special reports that are due to federal agencies over and above the AFR and the single audit package. But by and large, there's a good benefit to the single audit. Okay, come on. Okay, understanding when a federal award is expended and therefore reported is also a language unto itself. Now, in some cases, reporting occurs when funds are spent or dispersed. In other cases, it's when assets are received, especially in the case of donated property, such as food at schools or program income. Program income, this phrase program income allows, allowable interest earnings on federal awards, but in some cases, instead of it's reported, instead of received, it's reported when program income is spent. Now, loans, donated food or property and endowments all have specialized accounting and financial reporting. You may want to keep this handy if you're the person who is preparing the schedule of expenditure of federal awards. The audit is a compliance audit, meaning the auditee is either in compliance or it is not. Programs are organized into major programs based on risk and materiality. The starting point is the prior audit, which is then matched to the requirements in this year's compliance supplement. Within the compliance supplement, there's a matrix of compliance requirements. And most assistance numbers are listed with either a Y for yes or N for no. Kind of easy, don't you think? And yes means procedures are performed. No means no procedures performed. In some cases, the procedure is not applicable to the federal award. This is usually the first page all of us auditors flip to in the nearly 2,000 page listing of compliance requirements in every single audit. And so we flip here first just to plan and perform our audits. Now, if you're an auditor, there needs to be an understanding between compliance and controls. Both check on the presence and integrity of controls. But controls testing focuses on process, while compliance testing focuses on what is in the law, regulation, and contract, and so on. Again, compliance is a yes or no, while controls can be a spectrum. Okay, the scope of a single audit builds on the existing financial and government auditing standards. However, we got to test compliance, and that's not in financial auditing standards. It's in the compliance supplement, building on what we've already done in the financial audit. So it really includes the entirety of an auditee. Okay, who's responsible for a single audit? First, auditees are required to procure a single audit. They need to engage an auditee. If they don't engage an auditee, they're in violation of the terms and conditions of a federal award, the federal regulation, and perhaps laws and regulations. Auditees are responsible for preparing the financial statements, even if your auditor helps you. But ultimately, the auditee is responsible, including the CFA. We know, again, in many cases, you don't have the expertise to prepare your AFR, but you are still responsible. Ultimately, you're also responsible to remediate any audit issues known as findings. That's not the auditor's responsibility. They also must provide, your auditee must also provide access to books and records required for the single audit. The CFA, or Schedule of Expenditures or Federal Awards, is required by the Uniform Guidance. It's a schedule because it's not a full P&L. And it's just, it's a schedule format that'll show you in a little bit. The content of the schedule is established by OMB and the federal agencies. There's also notes, especially on loans, and the use of whether or not you used a 10% indirect cost rate. And accounting policies in preparing your CFA. By the way, there's no basis of accounting in the CFA, so your CFA numbers may be different than even your fund numbers. In some cases, it's prepared on a cash basis, which is fine as long as it's disclosed. Now, this is what a CFA looks like. Here, come on, let's go. Here we go. This is a snip, and I apologize for the small numbers. And if anybody is on from the city of Sioux Falls, South Dakota, you recognize this. This is you. Now, the layout is not always consistent across auditees, but the content is. Now, see also the right column listing the total provided as subrecipients, which is also important. So again, take a look at this. You know, you may want to zoom in on it at your leisure, or when you receive the PDF, take a look, and that is the proper format. Okay. Again, the notes to this schedule, there are notes to the schedule. There's also specific content. And in deference of time, take a look at this slide here, this list. This is a checklist for you. The notes here, come on, there we go. Notes are pretty straightforward. In a significant accounting policies, there's a reconciliation for the differences in accounting, disclosure if your government is using that 10% indirect cost rate, and loan balances and other information. Again, auditees are responsible to remediate findings or issues found in the audit. It's not the auditor who's responsible, you are. You got to prepare a plan to remediate, and that's called a corrective action plan. And if the finding carries from year to year, it's called a repeat finding. Now, the auditors can provide technical assistance and guidance to help you remediate, but ultimately it's your job. There is a further schedule showing the status of the last year finding, and the plan also includes the contact person who is responsible for the remediation. And when I was a preparer, it was frequently me. So I've been on the other end of those phone calls and emails. Remember, it is not the auditor. The contact information is mainly for that magic word called accountability. Now, again, where does this all go? It all gets summarized and goes into an audit package that's submitted to the federal government in a data warehouse known as the Federal Audit Clearinghouse. Now, a form is filled out by the auditee and it's signed by the auditor electronically, and that's known as a data collection form, just like your IRS tax return. It's due 30 days after the receipt of the auditor's report or 9 months after fiscal year end. For June 30 governments out there, that means March 31st of the following year. But if you receive your auditor's report, you got 30 days to submit this one. Now, what's the auditor's responsibility? Well, yeah, in essence, to be an auditor, to audit the financial statements, the CFA, and test for compliance. That compliance includes all the information applicable in the compliance supplement to follow up on prior audit findings and reporting. The auditor also signs the data collection form in some of the sections. Now, there is a further schedule of findings and question costs. All significant findings and deficiencies found by the auditor and material weaknesses are contained in the schedule. Known or likely question costs over $25,000 are also reported in this schedule. Now, the organization of a finding includes all the elements on this screen. Again, keep this one handy and notice that it includes your views on the findings, to which the auditor may have a differing view than you do, but it all gets written down and published in the Federal Audit Clearinghouse. Now, this leads to our final polling question. What does CFA stand for? There's a question on here. What is required regarding expenditures less than $750,000? Well, you do have a schedule of expenditure of federal awards. It just is not audited in a similar fashion. And if they're ARPA funds, then you might have a attestation engagement to examine those funds that are related to ARPA. So talk to your auditor on that one. In the net position section of the statement of net position, would right to use assets be considered part of unrestricted net position or investment in capital assets? Funny you should ask that. At the GASB on Tuesday in New York City, there was a discussion about that. And at the GASAC meeting on Monday, there was a discussion about that because there is a project going on non-financial assets. And so stay tuned. But if indeed it is a lease, it's probably part of your net investment in capital assets for now. Good question.
I know we are short on time, so polling questions open. Make sure you answer. But everyone went with 72% for option D.
Yep, schedule of expenditures of federal awards. You win the prize. All right. All right. So in any event, any other questions that I did not answer, because we're heading to the home stretch here? Let's see. I don't see any.
I think you got them.
I think so. All right. So our next webinar is coming up in a few weeks. I really thank you for taking the time today, your precious time. And I know we went about 90 seconds over, but feel free to send me an email. My contact information is on the screen. Thank you so much. Have a good afternoon.